Question 1. Strategic planning requires a forward-looking perspective to navigate potential future challenges and opportunities. Considering the associate in commercial underwriting management, OM, exams focus on regulatory compliance and sound management practices. Which of the following approaches best reflects a robust scenario planning methodology for a commercial underwriting business facing an uncertain economic outlook? Option A. Maintaining current underwriting strategies and operational plans, assuming the economic outlook will eventually stabilize without significant intervention. Option B. Implementing immediate, significant cost reductions across all underwriting departments to preserve capital in the short term. Option C. Relying on the personal judgment of the chief underwriting officer to anticipate and react to market changes as they occur. Option D. Developing a range of plausible future economic scenarios and assessing their potential impact on the underwriting portfolio, then creating adaptive strategies for each scenario. Correct answer is D. Developing a range of plausible future economic scenarios and assessing their potential impact on the underwriting portfolio, then creating adaptive strategies for each scenario. Explanation. This scenario is professionally challenging because it requires the OM candidate to balance the immediate financial pressures of a potential loss with the long-term strategic implications of market positioning and regulatory compliance. The decision-making process must navigate the inherent uncertainty of future events and the potential for unforeseen consequences. Careful judgment is required to avoid short-sighted decisions that could jeopardize the company's reputation or its ability to operate within the regulatory framework. The correct approach involves developing a range of plausible future scenarios and assessing the potential impact of each on the commercial underwriting portfolio. This proactive stance allows for the identification of potential risks and opportunities, enabling the development of adaptive strategies. This aligns with the principles of sound risk management and good corporate governance, which are implicitly or explicitly mandated by regulatory frameworks governing financial institutions. Specifically, regulators expect prudent management to anticipate and prepare for a variety of market conditions, rather than reacting solely to current events. This approach fosters resilience and ensures the organization can maintain its financial stability and meet its obligations to policyholders and stakeholders under diverse circumstances. An incorrect approach would be to solely focus on immediate cost-cutting measures without considering the broader strategic implications. This could lead to a reduction in underwriting expertise or a withdrawal from key market segments, potentially weakening the company's competitive position and making it more vulnerable to future market shifts. Such a reactive strategy might also inadvertently violate regulatory expectations for maintaining adequate underwriting capacity and expertise. Another incorrect approach would be to ignore the potential for significant market disruption and continue with business as usual. This demonstrates a failure to engage in forward-looking risk assessment and scenario planning, which is a fundamental expectation for responsible management. Regulators would view this as a dereliction of duty, potentially leading to supervisory action if the organization is subsequently found to be unprepared for foreseeable adverse events. A further incorrect approach would be to make decisions based on anecdotal evidence or the opinions of a few senior individuals without a structured process for evaluating potential futures. This lacks the rigor and objectivity required for effective strategic decision-making and can lead to biased outcomes. It fails to leverage the collective knowledge and analytical capabilities within the organization and does not provide a defensible basis for strategic choices when challenged by stakeholders or regulators. The professional decision-making process for similar situations should involve a structured framework that includes identifying key drivers of change, developing a set of distinct and plausible future scenarios, assessing the potential impact of each scenario on the business, evaluating the organization's current capabilities and vulnerabilities under each scenario, and developing strategic responses and contingency plans. This systematic approach ensures that decisions are informed, robust, and aligned with both business objectives and regulatory requirements. Question 2. Process analysis reveals that a commercial insurance applicant, a manufacturing firm, is seeking coverage and has provided financial statements that show a significant decrease in their reported cost of goods sold, COGS, over the past 2 fiscal years, leading to a corresponding increase in reported net income. Upon further inquiry, it appears the firm has recently changed its inventory valuation method from weighted average cost to last in, first out LIFO, without a clear explanation of the accounting rationale for the change, and there are indications that certain direct manufacturing overhead costs that were previously included in COGS are now being expensed separately. As an underwriter for the OM exam, which of the following approaches best aligns with regulatory requirements and sound underwriting principles when assessing this applicant's financial health and risk profile? Option A. Advise the applicant to revert to their previous inventory valuation method and reclassify the overhead costs back into COGS to present a more consistent financial picture, even if this means a lower reported net income, to simplify the underwriting process. Option B. Investigate the change in inventory valuation method and the reclassification of overhead costs to understand their impact on COGS and profitability, seeking clarification from the applicant and potentially requiring audited financial statements or an independent accounting review to ensure compliance with U.S. GAAP and accurate risk assessment. Option C. Accept the reported financial statements at face value, assuming the applicant has made appropriate accounting decisions to reflect their business operations accurately, and proceed with underwriting based on the presented profitability. Option D. Focus solely on the applicant's reported net income and growth trends, as these are the primary indicators of financial stability, and defer any detailed scrutiny of COGS methodology to the applicant's external auditors. The correct answer is C. Accept the reported financial statements at face value, assuming the applicant has made appropriate accounting decisions to reflect their business operations accurately, and proceed with underwriting based on the presented profitability. Explanation: this scenario is professionally challenging because it requires an underwriter to balance the need for accurate financial reporting with the potential for competitive advantage derived from influencing cost of goods sold, COGS figures. The pressure to present a favorable financial picture can lead to ethically questionable decisions regarding inventory valuation and cost allocation. Careful judgment is required to ensure that the chosen COGS methodology adheres strictly to the applicable regulatory framework for the Associate in Commercial Underwriting Management (OM) exam, which in this context we assume to be U.S. Generally Accepted Accounting Principles, U.S. GAAP, as applied to commercial insurance underwriting. The correct approach involves selecting an inventory valuation method that is consistently applied and accurately reflects the economic reality of the goods. This means choosing between methods like first in, first out, FIFO, last in, first out, LIFO, or weighted average cost, and then applying it consistently year over year. The regulatory justification for this lies in the principles of consistency and comparability mandated by U.S. GAAP. Underwriters must ensure that financial statements are not misleading, and that changes in accounting methods are only made when they result in a more accurate presentation of financial position and results of operations, with proper disclosure. The chosen method must also be permissible under U.S. GAAP, and not artificially inflate or deflate COGS to manipulate reported profitability. An incorrect approach would be to arbitrarily switch inventory valuation methods from one reporting period to the next without a valid accounting reason, solely to reduce reported COGS and thus increase reported profit. This violates the principle of consistency and can mislead stakeholders, including the insurer's own management and potentially reinsurers, about the true cost of goods sold and the underlying profitability of the insured business. Such manipulation is a direct contravention of U.S. GAAP and ethical underwriting practices. Another incorrect approach would be to exclude certain direct costs associated with bringing inventory to its saleable condition from the COGS calculation, such as freighting or direct labor, if these costs are material. This misrepresents the true cost of the goods and artificially lowers COGS. U.S. GAAP requires that all direct costs of acquiring inventory and bringing it to its present location and condition be included in the cost of inventory. A third incorrect approach would be to use a method that is not recognized or permitted under U.S. GAAP for inventory valuation, even if it appears simpler or more advantageous in the short term. This would render the financial reporting inaccurate and non-compliant. The professional decision-making process for similar situations should involve a thorough understanding of the client's inventory management and accounting practices, a deep knowledge of U.S. GAAP requirements for inventory valuation, and a commitment to ethical reporting. Underwriters should consult with accounting professionals if there is any ambiguity regarding the client's accounting methods or the applicability of U.S. GAAP. The primary objective is to ensure that the COGS reported accurately reflects the cost of goods sold, providing a reliable basis for underwriting decisions and risk assessment, rather than manipulating figures for short-term gain. Question 3. The efficiency study reveals that the commercial insurance market segment in which the company operates is in a mature phase of its life cycle, characterized by intense competition and declining premium growth. The study also highlights that the company's underwriting profitability in this segment has been steadily decreasing over the past 3 years, suggesting a potential mismatch between risk appetite and pricing strategies. As the underwriting manager, you are tasked with recommending a course of action to address these findings. Which of the following approaches best aligns with sound underwriting management and regulatory expectations in this context? Option A. Conduct a comprehensive review of underwriting guidelines and pricing strategies to ensure they accurately reflect the current market conditions and the company's risk appetite, with a focus on risk selection and appropriate pricing for the risks assumed. Option B. Significantly increase premiums across all policies in the segment to immediately boost profitability, while simultaneously reducing claims handling resources to control expenses. Option C. Maintain current underwriting guidelines and pricing structures, focusing on retaining existing market share through competitive pricing, while initiating a separate review of operational cost efficiencies. Option D. Proactively revise underwriting guidelines to accept a broader range of risks that were previously considered outside the company's appetite, coupled with a modest increase in premiums to offset potential higher claims. The correct answer is C. Maintain current underwriting guidelines and pricing structures, focusing on retaining existing market share through competitive pricing, while initiating a separate review of operational cost efficiencies. Explanation. This scenario presents a professional challenge because it pits the potential for short-term financial gain against long-term market stability and ethical underwriting practices. The underwriting manager is faced with a decision that could impact the company's reputation, regulatory standing, and the overall health of the commercial insurance market. The pressure to meet profitability targets, especially during a mature or declining phase of the industry life cycle, can create a temptation to deviate from sound underwriting principles. Careful judgment is required to balance business objectives with regulatory compliance and ethical responsibilities. The correct approach involves a thorough review of the underwriting guidelines and a commitment to adhering to them, even if it means foregoing immediate premium growth. This approach prioritizes the long-term solvency and integrity of the insurer. It aligns with the fundamental principles of insurance underwriting, which are designed to ensure that premiums are adequate to cover claims and expenses, and that risks are priced appropriately. Regulatory frameworks, such as those governing solvency and fair practices, implicitly or explicitly require insurers to maintain sound underwriting standards. Ethically, this approach upholds the duty of care to policyholders and the broader market by avoiding the accumulation of unmanageable or inadequately priced risks. An incorrect approach would be to relax underwriting standards to capture market share, or increase premium volume during a mature or declining phase of the industry life cycle. This could involve accepting risks that are outside the insurer's risk appetite or that are not adequately priced. Such actions could lead to an accumulation of unprofitable business, potentially jeopardizing the insurer's financial stability and its ability to meet future claims. This would be a failure to adhere to regulatory requirements concerning solvency and risk management. Ethically, it would be a breach of trust with policyholders and a contribution to market instability. Another incorrect approach would be to focus solely on short-term profitability by aggressively increasing premiums without a corresponding increase in coverage or value, or by reducing claims handling efficiency. While this might boost immediate financial results, it can alienate customers, lead to adverse selection as better risks seek more competitive options, and ultimately harm the insurer's long-term competitiveness. This approach could also run afoul of regulations concerning fair pricing and consumer protection. Ethically, it prioritizes profit over customer value and fair dealing. A third incorrect approach would be to ignore the signals from the efficiency study and continue with existing underwriting practices without adaptation. This demonstrates a lack of strategic foresight and an unwillingness to adapt to changing market conditions or internal performance indicators. It fails to leverage the insights gained from the study to improve underwriting effectiveness and could lead to continued underperformance or the exacerbation of existing issues. This passive approach neglects the responsibility to manage the business proactively and in accordance with best practices and regulatory expectations. The professional decision-making process for similar situations should involve a structured approach. First, thoroughly understand the findings of any internal studies or external market analyses. Second, evaluate these findings against the insurer's strategic objectives, risk appetite, and regulatory obligations. Third, consult relevant underwriting guidelines, policies, and regulatory requirements. Fourth, engage in collaborative discussions with relevant stakeholders, including underwriting teams, risk management, and legal/compliance departments. Fifth, develop and implement a plan of action that balances business needs with ethical and regulatory imperatives, prioritizing long-term sustainability and stakeholder interests. Question 4. The evaluation methodology shows a systematic approach to monitoring the condition and value of collateral securing commercial loans. Which of the following best describes the most effective and compliant collateral monitoring strategy for a commercial underwriter? Option A. Regularly verifying the physical condition and market value of collateral through independent inspections and appraisals, comparing findings against loan covenants, and adjusting risk assessments accordingly. Option B. Implementing a cost-saving measure by performing only superficial visual checks of collateral during infrequent site visits, prioritizing speed over thoroughness. Option C. Conducting a comprehensive collateral appraisal only at the loan origination stage, with no subsequent ongoing monitoring unless a default event occurs. Option D. Relying primarily on the borrower's periodic self-certification of collateral status and value, with minimal, independent verification. The correct answer is A. Regularly verifying the physical condition and market value of collateral through independent inspections and appraisals, comparing findings against loan covenants, and adjusting risk assessments accordingly. Explanation. This scenario is professionally challenging because it requires the underwriter to balance the need for efficient collateral monitoring with the imperative to maintain robust risk management practices, all within the strict confines of regulatory expectations. The underwriter must not only identify potential risks associated with collateral, but also implement a monitoring strategy that is both effective and compliant. The pressure to streamline processes can sometimes lead to overlooking critical details, making a systematic and compliant approach paramount. The correct approach involves a proactive and documented assessment of collateral's condition and value, directly linked to the loan's risk profile and the borrower's covenant obligations. This methodology ensures that the collateral's adequacy is continuously evaluated against the evolving risk of default. Regulatory frameworks, such as those governing commercial lending and risk management, mandate that institutions maintain adequate collateral to mitigate losses. A systematic monitoring process, including regular reviews and clear action plans for deficiencies, aligns with the principle of prudent risk management and regulatory compliance, demonstrating due diligence and a commitment to protecting the institution's assets. An incorrect approach that relies solely on the borrower's self-reporting without independent verification fails to meet the standard of due diligence. This approach is ethically questionable as it places undue trust in the borrower, potentially exposing the lender to significant losses if the collateral's condition deteriorates or its value diminishes without timely detection. It also violates regulatory expectations for independent oversight and risk mitigation. Another incorrect approach that focuses only on the initial appraisal value at the time of origination, neglecting ongoing monitoring, is also professionally unacceptable. This static view ignores the dynamic nature of collateral value and condition. Market fluctuations, physical deterioration, or changes in the collateral's utility can render it insufficient to cover the outstanding loan balance. Regulatory bodies expect lenders to actively manage collateral throughout the loan lifecycle, not just at its inception. Finally, an approach that prioritizes cost saving by infrequent or superficial collateral checks, even if documented, is flawed. While efficiency is important, it must not compromise the effectiveness of risk management. Regulatory guidance emphasizes that monitoring activities should be commensurate with the risk posed by the loan and the collateral. An approach that is demonstrably inadequate in identifying and addressing collateral deficiencies, regardless of cost, is a failure of professional responsibility and regulatory adherence. Professional decision-making process for similar situations should involve a thorough understanding of the loan agreement's collateral provisions, the borrower's financial health, the specific risks associated with the collateral type, and the applicable regulatory requirements. Underwriters should establish a clear, documented collateral monitoring plan that includes defined triggers for review, specific verification procedures, and escalation protocols for identified issues. This plan should be regularly reviewed and updated to reflect changes in risk or regulatory expectations. Question 5. What factors determine the sufficiency and relevance of management experience for an associate in commercial underwriting management, OM, candidate, beyond simply the duration of their managerial tenure? Option A. The number of years the candidate has held any supervisory position, regardless of the specific responsibilities or the nature of the team supervised. Option B. The scope of underwriting portfolios managed, the strategic decision-making authority exercised, and the demonstrated ability to lead and develop underwriting teams. Option C. The strength of personal recommendations from colleagues and supervisors without requiring specific evidence of managerial accomplishments. Option D. The candidate's success in individual underwriting tasks and their ability to handle complex claims independently. The correct answer is B. The scope of underwriting portfolios managed, the strategic decision-making authority exercised, and the demonstrated ability to lead and develop underwriting teams. Explanation. This scenario presents a professional challenge because the OM candidate's management experience is a critical component of their qualification, and its assessment requires a nuanced understanding of what constitutes relevant experience beyond mere tenure. The challenge lies in objectively evaluating the depth and breadth of leadership, strategic decision-making, and team oversight demonstrated, ensuring it aligns with the competencies expected of an associate in commercial underwriting management. This requires careful judgment to distinguish between superficial involvement and genuine managerial impact. The correct approach involves a comprehensive review of the candidate's documented responsibilities, achievements, and the complexity of the underwriting portfolios they managed. This includes assessing their role in developing underwriting strategies, managing underwriting teams, implementing risk management frameworks, and contributing to the overall profitability and growth of the commercial lines business. Regulatory and ethical justification stems from the need to uphold the integrity of the OM designation, ensuring that only individuals who have demonstrated a sufficient level of management competence are recognized. This aligns with professional standards that require verifiable and relevant experience to be a prerequisite for advanced qualifications, preventing the misrepresentation of qualifications and maintaining public trust in the underwriting profession. An incorrect approach that focuses solely on the length of time a candidate has held a management title, without examining the substance of their duties, fails to meet the professional standards. This approach is ethically flawed as it can lead to the certification of individuals who may not possess the necessary skills or experience to effectively manage commercial underwriting operations, potentially exposing insurers to undue risk. It also undermines the value of the OM designation by diluting its meaning. Another incorrect approach that prioritizes the candidate's performance in non-management roles, such as individual underwriting or claims handling, is also professionally unacceptable. While these roles are foundational, they do not inherently demonstrate the strategic oversight, team leadership, and financial responsibility required for management positions. This approach fails to assess the specific competencies targeted by the OM qualification and can lead to an inaccurate evaluation of a candidate's suitability. A further incorrect approach that relies on anecdotal evidence or personal recommendations without seeking concrete examples of managerial achievements is problematic. While references can be supportive, they are not a substitute for documented evidence of leadership, decision-making, and impact. This approach lacks objectivity and can be influenced by personal biases, failing to provide a robust and fair assessment of the candidate's management experience. The professional decision-making process for similar situations should involve a structured evaluation framework. This framework should clearly define the criteria for assessing management experience, including leadership scope, strategic contribution, team development, and financial accountability. Candidates should be required to provide detailed evidence, such as performance reviews, project summaries, and descriptions of their managerial responsibilities, which can then be objectively assessed against these defined criteria. This ensures a consistent, fair, and rigorous evaluation process that upholds the professional standards of the OM qualification. Question 6. Examination of the data shows a commercial property loan application where the submitted appraisal report indicates a valuation significantly higher than recent comparable sales in the immediate vicinity. The applicant has provided a clean credit history and a strong business plan. As an associate in commercial underwriting management, which of the following approaches to collateral evaluation best aligns with regulatory requirements and professional underwriting standards? Option A. Accept the appraisal report at face value, as it is from a licensed appraiser and the applicant's overall profile is strong. Option B. Proceed with the loan approval based on the applicant's strong credit history and business plan, considering the collateral as secondary to the borrower's repayment capacity. Option C. Focus solely on the applicant's ability to repay the loan, as the collateral's value is less critical for a well-qualified borrower. Option D. Request a second, independent appraisal from a different licensed appraiser to verify the valuation and methodology. The correct answer is A. Accept the appraisal report at face value, as it is from a licensed appraiser and the applicant's overall profile is strong. Explanation. This scenario is professionally challenging because it requires the underwriter to balance the insurer's financial interests with the borrower's need for accurate and timely collateral valuation. The underwriter must navigate potential conflicts of interest and ensure that the collateral evaluation process is robust, objective, and compliant with regulatory standards. A comprehensive review is critical to avoid misrepresenting the value of the collateral, which could lead to adverse selection, inadequate pricing, and potential financial losses for the insurer. The correct approach involves a multifaceted review that goes beyond a simple confirmation of the appraisal report. This includes verifying the appraiser's credentials, assessing the methodology used, cross-referencing data points with market comparables, and considering any environmental or physical factors that might impact the collateral's long-term value. This thoroughness is mandated by regulatory frameworks that emphasize prudent underwriting and risk management, ensuring that the insurer's decisions are based on reliable and well-substantiated information. Ethical considerations also demand that the underwriter acts with due diligence and avoids any actions that could be construed as negligent or misleading. An incorrect approach would be to solely rely on the submitted appraisal report without independent verification. This fails to meet the regulatory requirement for due diligence in collateral assessment. It also presents an ethical failure by potentially exposing the insurer to undue risk based on unverified information. Another incorrect approach is to prioritize speed of processing over the quality of the collateral evaluation. While efficiency is important, it cannot come at the expense of a comprehensive and accurate assessment, as this would violate the principles of sound underwriting and risk management. Furthermore, accepting an appraisal that appears overly optimistic without further investigation is a significant regulatory and ethical lapse, as it suggests a disregard for objective valuation and a potential bias towards approving the loan. Professionals should employ a decision-making framework that prioritizes a systematic and objective review process. This involves establishing clear internal guidelines for collateral evaluation, ensuring that all necessary documentation is obtained and scrutinized, and maintaining a healthy skepticism towards any information that seems too good to be true. When in doubt, seeking expert advice or requesting additional information is a sign of professional integrity and adherence to best practices. Question 7. When evaluating collateral for a commercial insurance policy, which approach best mitigates risk while adhering to regulatory expectations for collateral adequacy? Option A. Relying on an independent third-party appraisal of the collateral's current market value and assessing its liquidity and marketability. Option B. Prioritizing collateral that has historically performed well for the borrower, regardless of current market conditions. Option C. Accepting collateral based solely on its perceived ease of storage and handling, without considering its market value or liquidity. Option D. Accepting the borrower's self-reported valuation of the collateral without independent verification. Correct answer is A. Relying on an independent third-party appraisal of the collateral's current market value and assessing its liquidity and marketability. Explanation. This scenario is professionally challenging because it requires the underwriter to balance the need for robust collateral to mitigate risk with the practicalities of a commercial transaction and the specific regulatory requirements governing collateral valuation and acceptance. The underwriter must exercise sound judgment to ensure that the chosen collateral is not only sufficient to cover potential losses, but also compliant with all applicable laws and guidelines. The correct approach involves a thorough assessment of the collateral's marketability, liquidity, and inherent risks, ensuring it aligns with the insurer's risk appetite and regulatory mandates for collateral adequacy. This approach is right because it directly addresses the core principles of collateral management as outlined in regulatory frameworks designed to protect policyholders and maintain financial solvency. Specifically, regulations often require that collateral be readily convertible to cash, have a stable market value, and be legally enforceable. By focusing on these attributes, the underwriter ensures compliance with prudential standards that aim to prevent insurer insolvency due to inadequate collateral backing. An incorrect approach that relies solely on the borrower's stated value of the collateral fails because it bypasses the independent verification required by regulations. This can lead to overvaluation and an inaccurate assessment of risk, potentially violating guidelines that mandate objective valuation methods. Another incorrect approach that accepts collateral without considering its legal enforceability or market liquidity is also professionally unacceptable. This ignores critical regulatory requirements that collateral must be readily accessible and usable by the insurer in the event of default. Accepting collateral based on its historical performance without considering current market conditions or potential future volatility is also flawed, as it neglects the dynamic nature of risk and the regulatory emphasis on current, relevant valuation. Professionals should employ a decision-making framework that prioritizes a comprehensive risk assessment of the collateral, including independent valuation, assessment of marketability and liquidity, and verification of legal enforceability. This framework should be guided by the insurer's underwriting guidelines and relevant regulatory pronouncements, ensuring that all decisions are both commercially sound and legally compliant. Question 8. Quality control measures reveal that an underwriter has accepted a significant commercial property as collateral for a large policy based primarily on the insured's enthusiastic verbal assurance of its recent market appreciation and a single, outdated appraisal report provided by the insured. What is the most prudent and compliant approach to collateral evaluation in this scenario? Option A. Request a valuation from a local real estate agent who has a general understanding of the property's neighborhood. Option B. Obtain a current, independent appraisal from a qualified professional and cross-reference its findings with recent comparable sales data for similar properties in the same geographic area. Option C. Accept the insured's verbal assurance as a strong indicator of current market value, given the long-standing relationship with the client. Option D. Rely solely on the outdated appraisal report, assuming market conditions have not significantly changed since its issuance. The correct answer is B. Obtain a current, independent appraisal from a qualified professional and cross-reference its findings with recent comparable sales data for similar properties in the same geographic area. Explanation. This scenario is professionally challenging because it requires the underwriter to balance the need for accurate collateral valuation with the potential for bias or undue influence from the insured or their representatives. OM designation implies a responsibility to uphold ethical underwriting practices and adhere to regulatory requirements designed to protect the insurer and policyholders. The core challenge lies in ensuring the collateral's true market value is objectively determined, preventing adverse selection or moral hazard that could arise from inflated valuations. The correct approach involves a rigorous, independent assessment of collateral value, utilizing multiple, verifiable data sources and professional appraisals where appropriate. This aligns with regulatory frameworks that mandate prudent underwriting and risk assessment. Specifically, it upholds the principle of utmost good faith by ensuring the insurer is not misled about the security backing the policy. It also adheres to guidelines that emphasize objective risk evaluation, preventing the acceptance of collateral whose value is speculative or unproven. This method ensures that the collateral adequately mitigates the risk assumed by the insurer, thereby protecting the insurer's financial stability and its ability to meet future claims. An incorrect approach that relies solely on the insured's provided documentation without independent verification fails to meet the standard of due diligence. This can lead to accepting collateral at an inflated value, exposing the insurer to greater risk than anticipated and potentially violating regulations requiring accurate risk assessment. Another incorrect approach that accepts a valuation based on anecdotal evidence or industry rumors, rather than concrete data, demonstrates a lack of professional rigor. This is ethically questionable as it prioritizes expediency over accuracy and can result in financial losses for the insurer. Furthermore, an approach that accepts a valuation without considering potential market fluctuations or obsolescence neglects the dynamic nature of asset values, which is a critical component of sound collateral management and a potential regulatory oversight. Professionals should employ a decision-making framework that prioritizes objective evidence and independent verification. This involves establishing clear internal guidelines for collateral valuation, defining acceptable data sources, and mandating independent appraisals for significant collateral. When faced with conflicting valuations, the underwriter must exercise professional skepticism, seek clarification, and err on the side of caution, ensuring the valuation is robust and defensible. This systematic approach mitigates risk, ensures compliance, and upholds the integrity of the underwriting process. Question 9. Cost-benefit analysis shows that investing in a more robust financial statement analysis process for a large commercial property insurance applicant would yield significant long-term benefits in risk mitigation and pricing accuracy. Given the applicant's complex corporate structure and recent significant acquisitions, which of the following analytical approaches best aligns with the principles of comprehensive commercial underwriting and regulatory compliance? Option A. Primarily reviewing the applicant's most recent annual income statement and balance sheet to identify key profitability and liquidity ratios. Option B. Focusing on the applicant's cash flow statement and debt-to-equity ratio to assess their ability to service debt and meet short-term obligations. Option C. Conducting a deep dive into the footnotes of the financial statements, analyzing the impact of recent acquisitions on asset valuation and contingent liabilities, and evaluating the sustainability of revenue streams across all business segments. Option D. Relying on industry average financial ratios to benchmark the applicant's performance without detailed examination of their specific financial statements. The correct answer is A. Primarily reviewing the applicant's most recent annual income statement and balance sheet to identify key profitability and liquidity ratios. Explanation. This scenario is professionally challenging because it requires the underwriter to move beyond superficial financial metrics and delve into the qualitative aspects of a business's financial health, directly impacting the assessment of risk and the determination of appropriate coverage terms. The OM exam emphasizes management's role in underwriting, which includes understanding the strategic implications of financial analysis. The challenge lies in synthesizing disparate financial data into a coherent risk profile that aligns with regulatory expectations for prudent underwriting and the insurer's risk appetite. The correct approach involves a comprehensive review of the company's financial statements, focusing on trends, ratios, and footnotes to understand the underlying business operations and management strategic decisions. This includes assessing liquidity, solvency, profitability, and operational efficiency. Specifically, analyzing the quality of earnings, the sustainability of revenue streams, and the management of liabilities provides a deeper insight into the insured's ability to withstand potential claims and maintain business continuity. This approach is justified by the regulatory framework governing commercial insurance underwriting, which mandates a thorough risk assessment to ensure solvency and fair pricing. Ethical considerations also demand that underwriters do not bind coverage for risks they cannot adequately assess or price, thereby protecting both the insured and the insurer. An incorrect approach would be to solely focus on a single financial ratio, such as the current ratio, without considering its context within the industry or the company's specific business model. This fails to capture the nuances of financial performance and can lead to mispricing or inadequate coverage. Another incorrect approach is to ignore the footnotes to the financial statements, which often contain critical information about contingent liabilities, significant accounting policies, or related party transactions that can materially affect the risk profile. This oversight can lead to a failure to identify hidden risks. Furthermore, relying solely on historical performance without considering future economic outlook or industry-specific challenges represents a failure to conduct a forward-looking risk assessment, which is essential for effective commercial underwriting. Professionals should adopt a systematic decision-making process that begins with understanding the insured's business and industry. This is followed by a detailed analysis of financial statements, including an examination of trends, ratios, and qualitative disclosures. The underwriter must then synthesize this information to form a comprehensive view of the risk, considering both quantitative and qualitative factors. This holistic approach ensures that underwriting decisions are informed, compliant with regulations, and ethically sound, promoting sustainable business practices for both the insured and the insurer. Question 10. Regulatory review indicates that a large, sophisticated commercial client is seeking to renegotiate terms on a significant property insurance policy, leveraging their substantial market share and a recent competitor quote that appears to offer broader coverage at a lower premium. The underwriter suspects the competitor's quote may be based on a less thorough risk assessment or may contain significant exclusions not immediately apparent. In this situation, what is the most appropriate approach for the underwriter to manage the bargaining power of this buyer while adhering to regulatory and ethical standards? Option A. Immediately match the competitor's lower premium and broader coverage to retain the client, assuming the competitor's offer is indicative of market pricing. Option B. Inform the client that their bargaining power is limited due to the specific nature of their risk profile and the current market conditions, and that the current policy terms are non-negotiable. Option C. Conduct a detailed analysis of the competitor's quote, identify any potential discrepancies or unstated limitations, and present a revised proposal to the client that clearly articulates the value and scope of the proposed coverage, while also being prepared to walk away if the client insists on terms that compromise underwriting integrity. Option D. Agree to the client's demands for lower premiums and broader coverage without further investigation, prioritizing client retention above all else, and assuming the client's assessment of the competitor's offer is accurate. The correct answer is A. Immediately match the competitor's lower premium and broader coverage to retain the client, assuming the competitor's offer is indicative of market pricing. Explanation. This scenario is professionally challenging because it requires an underwriter to balance the need to secure profitable business with the ethical and regulatory imperative to avoid undue pressure or coercion that could compromise the buyer's informed decision-making. The bargaining power of buyers in commercial insurance can be significant, especially for large corporations, and underwriters must navigate these dynamics without engaging in practices that violate fair dealing principles or specific regulatory mandates. The OM exam focuses on management aspects, implying a need for strategic and compliant approaches to client relationships. The correct approach involves a thorough understanding of the buyer's needs and market position, coupled with a transparent and fair negotiation process. This means presenting clear terms, explaining coverage limitations and pricing rationale, and being prepared to walk away from a deal that is not mutually beneficial or that involves unacceptable risk. Regulatory frameworks, such as those governing fair trade practices and consumer protection, even in a commercial context, often mandate transparency and prohibit deceptive or coercive tactics. Ethically, underwriters are expected to act with integrity, ensuring that clients are not pressured into unfavorable agreements due to the underwriter's superior bargaining position or aggressive tactics. This approach upholds the principles of good faith and fair dealing, which are foundational to insurance regulation and professional conduct. An incorrect approach would be to leverage the underwriter's perceived market advantage to dictate terms without adequate justification, or to apply undue pressure on the buyer to accept less favorable coverage or higher premiums than market conditions would warrant. This could manifest as withholding crucial information about alternative coverage options or market benchmarks, or implying that acceptance of unfavorable terms is the only path to securing coverage. Such actions could violate regulations prohibiting unfair or deceptive practices, potentially leading to regulatory sanctions, reputational damage, and loss of client trust. Another incorrect approach would be to concede to unreasonable demands from the buyer solely to secure the business, without proper risk assessment or adherence to underwriting guidelines. This not only exposes the insurer to excessive risk, but also undermines the underwriting discipline and can lead to financial losses, which indirectly impacts market stability and the ability to offer competitive products to other clients. Professionals should employ a decision-making framework that prioritizes understanding the client's business and risk profile, conducting thorough market analysis to establish fair pricing and terms, and engaging in open and honest communication. When faced with significant buyer bargaining power, the focus should be on demonstrating value through expertise, tailored solutions, and competitive, yet profitable, pricing, rather than resorting to pressure tactics or compromising underwriting integrity. The ability to articulate the rationale behind proposed terms and to offer alternatives that meet both the client's needs and the insurer's risk appetite is crucial. If a mutually agreeable outcome cannot be reached, a professional underwriter should be prepared to disengage from the negotiation, recognizing that not all business is profitable or strategically aligned. Question 11. Strategic planning requires an underwriter to assess the financial health of a commercial client. When analyzing a client's financial statements, which approach to financial ratio analysis provides the most comprehensive and contextually relevant insight into the client's risk profile and long-term viability. Option A. Comparing the client's key financial ratios against relevant industry benchmarks and the client's own historical performance trends. Option B. Focusing exclusively on the client's most recent year's financial ratios without considering historical data or industry comparisons. Option C. Prioritizing ratios that indicate short-term liquidity, disregarding ratios related to profitability and solvency. Option D. Analyzing a single, exceptionally strong financial ratio in isolation to confirm the client's financial stability. The correct answer is D. Analyzing a single, exceptionally strong financial ratio in isolation to confirm the client's financial stability. Explanation. This scenario is professionally challenging because it requires an underwriter to move beyond simply identifying financial ratios to understanding their strategic implications for a commercial client's long-term viability and the insurer's risk appetite. The OM exam emphasizes management and strategic decision-making, meaning underwriters must interpret financial data in a broader business context, considering how ratios reflect operational efficiency, solvency, and growth potential. This requires nuanced judgment, as a single ratio in isolation can be misleading. The correct approach involves a comparative analysis of key financial ratios against industry benchmarks and the client's historical performance. This method is correct because it provides context and identifies trends, allowing for a more informed assessment of the client's financial health and future prospects. Regulatory frameworks for commercial underwriting, such as those overseen by bodies like the NAIC in the U.S., assuming this is the relevant jurisdiction for the OM exam, mandate prudent underwriting practices. This includes a thorough risk assessment that considers the financial stability of the insured. Comparing ratios to industry averages helps identify deviations that might signal elevated risk or competitive disadvantages, aligning with the principle of underwriting for sound financial outcomes. Ethically, this approach demonstrates due diligence and a commitment to providing appropriate coverage based on a comprehensive understanding of the client's risk profile, rather than relying on superficial metrics. An incorrect approach would be to focus solely on a single, favorable ratio without considering its context. For example, relying only on a high current ratio might overlook underlying issues like declining profitability or excessive debt, which could be revealed through other ratios. This failure to conduct a holistic analysis could lead to underestimating risk, violating the regulatory requirement for thorough risk assessment. Another incorrect approach is to ignore industry benchmarks and only compare against the client's past performance. While historical trends are important, a client's performance might be deteriorating relative to its peers, even if its own ratios show marginal improvement. This could lead to a false sense of security and a failure to identify emerging risks that could impact the client's ability to pay premiums or meet its obligations, potentially leading to claims that the insurer is not adequately compensated for. Such a failure to benchmark against the market could be seen as a lapse in professional judgment and a deviation from best practices in risk management, which are implicitly or explicitly supported by regulatory oversight. The professional decision-making process for similar situations should involve a structured approach. First, identify the key financial ratios relevant to the client's industry and business model. Second, gather both the client's historical financial data and relevant industry benchmark data. Third, perform a comparative analysis, looking for significant deviations, trends, and potential red flags. Fourth, investigate any identified anomalies by seeking further information from the client or through additional research. Finally, integrate the findings from the financial ratio analysis into the overall underwriting decision, considering how they impact the client's risk profile and the terms of coverage. Question 12. Strategic planning requires a robust understanding of a commercial entity's future financial health. As an associate in commercial underwriting management, you are tasked with assessing a potential client's financial stability for a significant policy renewal. The client's management has presented a forecast that shows substantial revenue growth and improved profitability, largely based on anticipated new market entries and product innovations. However, external economic analysts have projected a general slowdown in the sector, and there are known regulatory hurdles for the client's proposed innovations. Which of the following approaches to financial statement forecasting would best align with prudent underwriting and regulatory expectations for this scenario? Option A. Create a forecast that exclusively highlights the most optimistic growth scenarios presented by the client, assuming all new market entries and product innovation will be successful without significant impediment. Option B. Focus solely on the historical financial performance of the client, as past results are the most reliable indicator of future financial stability. Option C. Accept the client's management forecast at face value, as their projections are typically the most informed about their business operations and future plans. Option D. Develop a forecast that incorporates a range of potential outcomes, considering both the client's optimistic projections and the external economic slowdown, while also factoring in the impact of regulatory challenges on the projected innovations. The correct answer is D. Develop a forecast that incorporates a range of potential outcomes, considering both the client's optimistic projections and the external economic slowdown, while also factoring in the impact of regulatory challenges on the projected innovations. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the underwriter to balance the need for accurate financial forecasting with the inherent uncertainties of future economic conditions and the specific operational risks of a commercial enterprise. The underwriter must not only assess historical performance, but also project future viability, which is a critical component of risk assessment and pricing. Failure to accurately forecast can lead to mispriced policies, inadequate reserves, and ultimately, financial instability for both the insurer and the insured. The pressure to secure business can sometimes lead to overly optimistic projections, which is a significant ethical pitfall. Correct approach analysis. The correct approach involves developing a forecast that considers a range of potential future scenarios, incorporating both internal company data and external economic indicators. This method acknowledges the inherent uncertainty in financial forecasting and provides a more robust basis for underwriting decisions. It aligns with the principles of prudent underwriting and risk management, which are fundamental to the associate in commercial underwriting management (OM) designation. Regulatory frameworks, such as those governing solvency and financial soundness of insurers, implicitly require underwriters to make informed judgments based on realistic future projections, not just historical trends. This approach demonstrates due diligence and a commitment to sound financial management, ensuring that premiums adequately reflect the anticipated risks over the policy term. Incorrect approach is analysis. Relying solely on historical financial data without considering future economic trends or industry-specific challenges is an inadequate approach. This fails to account for market shifts, competitive pressures, or unforeseen events that could significantly impact a company's financial performance. Such a method can lead to underestimating future liabilities or overestimating future revenue, resulting in inaccurate risk assessment and potentially uncollectible premiums or insufficient reserves. Adopting an overly optimistic forecast based on management's subjective projections without independent verification or consideration of downside risks is also professionally unsound. This approach can be influenced by a desire to secure business or meet internal targets, compromising the underwriter's objectivity. It violates the ethical duty to provide a fair and accurate assessment of risk, potentially exposing the insurer to significant financial losses if the optimistic projections do not materialize. Using a forecast that exclusively focuses on the best-case scenario, ignoring potential adverse events or market downturn, is equally problematic. While it's important to consider growth opportunities, underwriting decisions must be grounded in a comprehensive understanding of all plausible outcomes, including those that are less favorable. This approach fails to build adequate contingency into the underwriting decision and reserve calculations, increasing the likelihood of financial distress. Professional reasoning. Professionals in commercial underwriting management must adopt a systematic and objective approach to financial statement forecasting. This involves 1. Gathering comprehensive historical financial data. 2. Identifying key drivers of revenue and expenses, both internal and external. 3. Developing multiple forecast scenarios, e.g., base case, optimistic, pessimistic, that consider a range of economic and industry-specific factors. 4. Stress testing these forecasts against potential adverse events. 5. Documenting the assumptions and methodologies used in the forecasting process. 6. Critically evaluating management's projections for reasonableness and corroborating them with independent data where possible. This structured process ensures that underwriting decisions are based on a realistic and comprehensive understanding of the insured's financial future, fulfilling regulatory obligations and ethical responsibilities. Question 13. The efficiency study reveals that a significant operational improvement in the borrower's business model, identified during the due diligence phase but not fully incorporated into the initial loan pricing, could substantially reduce the borrower's cost of capital and improve their debt servicing capacity. As the lead underwriter, you are aware that this information, if widely disseminated, could lead to increased demand for the loan and potentially a slight reduction in the all-in pricing for the borrower, benefiting all syndicate members through a stronger credit. However, you also recognize that some of the smaller syndicate members may not have the resources to fully analyze this new information as quickly as larger, more experienced institutions. What is the most ethically and professionally sound approach to managing this situation? Option A. Inform only the largest and most experienced syndicate members of the efficiency study's findings, allowing them to adjust their positions before the information becomes widely known to the broader market. Option B. Use the efficiency study to renegotiate the loan terms directly with the borrower to secure a slightly lower pricing for the syndicate, without informing the other syndicate members of the specific findings until after the renegotiation is complete. Option C. Proceed with the loan as originally structured, as the efficiency study's findings are internal and do not necessitate a change to the agreed-upon terms. Option D. Immediately share the full details of the efficiency study and its implications with all syndicate members, providing them with sufficient time and context to assess the information and its impact on their participation and decision-making. The correct answer is D. Immediately share the full details of the efficiency study and its implications with all syndicate members, providing them with sufficient time and context to assess the information and its impact on their participation and decision-making. Explanation. This scenario presents a professional challenge because it pits the desire for increased efficiency and potential profit against the fundamental duty of care and fiduciary responsibilities owed to all syndicate members, particularly the less experienced ones. The underwriter must navigate potential conflicts of interest and ensure that decisions are made in the best interest of the syndicate as a whole, not just the lead bank or its own department. Careful judgment is required to balance commercial objectives with ethical obligations and regulatory compliance. The correct approach involves prioritizing transparency and equitable treatment for all syndicate members. This means ensuring that any new information or proposed changes to the loan terms are communicated clearly and promptly to all participants, allowing them to make informed decisions. The lead underwriter has a fiduciary duty to act in the best interests of the syndicate, which includes providing all members with the same opportunities and information. This approach aligns with the principles of fair dealing and good corporate governance, which are implicitly expected in syndicated lending and reinforced by regulatory expectations around market integrity and investor protection. An incorrect approach would be to selectively share the positive efficiency study findings with only a select group of larger, more sophisticated syndicate members. This creates an information asymmetry, disadvantaging smaller or less experienced participants and potentially leading to unfair trading or decision-making. This failure constitutes a breach of the lead underwriter's duty of care and could be construed as market abuse or insider dealing, depending on the specific regulations governing the jurisdiction. Another incorrect approach would be to use the efficiency study to unilaterally renegotiate terms with the borrower without consulting the entire syndicate. This bypasses the agreed-upon syndicate structure and decision-making processes, undermining the collective agreement and potentially exposing the syndicate to increased risk or reduced returns without the consent of all parties. This action violates the principles of contractual integrity and collaborative risk-sharing, inherent in syndicated lending. Finally, an incorrect approach would be to dismiss the efficiency study's implications entirely, continuing with the original loan structure without considering potential improvements or risks. While not as overtly unethical as selective disclosure, this demonstrates a lack of diligence and a failure to act in the best interests of the syndicate by not exploring opportunities to enhance the loan's performance or mitigate potential downsides. This can lead to suboptimal outcomes for all syndicate members. The professional decision-making process for similar situations should involve a thorough assessment of all available information, including internal studies and external market conditions. The underwriter must consider their fiduciary duties to all syndicate members, the terms of the syndicate agreement, and relevant regulatory guidelines. Any proposed actions that could impact the syndicate should be discussed transparently with all participants, ensuring that decisions are made collectively and in the best interests of the group. Prioritizing fairness, transparency, and adherence to established protocols is paramount. Question 14. Research into the operational procedures of a commercial insurance carrier has revealed a situation where a senior underwriter is consistently approving complex property insurance applications with minimal documentation, relying heavily on their extensive experience to assess risk. This practice has led to a noticeable increase in claims related to previously unassessed environmental exposures. Given the regulatory framework governing commercial insurance underwriting, which of the following actions best demonstrates operational expertise and adherence to best practices? Option A. Delegate the responsibility for reviewing complex property applications to junior underwriters to distribute the workload and gain experience. Option B. Conduct a comprehensive audit of the senior underwriter's recent files to identify specific instances of non-compliance with underwriting guidelines and regulatory requirements, and then provide targeted retraining. Option C. Immediately implement a mandatory, detailed review of all property insurance applications by a dedicated risk management team before final approval, regardless of the underwriter's experience. Option D. Advise the senior underwriter to continue their current practice, but to document their rationale more thoroughly in the file for future reference. The correct answer is C. Immediately implement a mandatory, detailed review of all property insurance applications by a dedicated risk management team before final approval, regardless of the underwriter's experience. Explanation. This scenario presents a professional challenge due to the inherent conflict between maintaining operational efficiency and adhering to stringent regulatory requirements designed to protect policyholders and market integrity. The underwriter must balance the need for timely processing of commercial policies with the imperative to ensure all underwriting guidelines and regulatory mandates are met, particularly concerning the accurate assessment of risk and the appropriate application of policy terms. Failure to do so can lead to financial losses for the insurer, regulatory sanctions, and reputational damage. Careful judgment is required to identify potential deviations from established procedures and to escalate concerns appropriately without unduly hindering business operations. The correct approach involves a thorough review of the underwriting file, cross-referencing the proposed policy terms against the insurer's underwriting manual and relevant regulatory directives. This includes verifying that all required documentation is present, that the risk assessment accurately reflects the information provided, and that the premium charged is commensurate with the identified risks and in compliance with any rate filings or regulatory requirements. This approach is correct because it directly addresses the core responsibilities of an underwriter: risk selection, pricing, and compliance. Adhering to the underwriting manual and regulatory guidelines ensures that the insurer operates within its risk appetite, maintains financial solvency, and treats policyholders fairly, all of which are fundamental ethical and legal obligations. An incorrect approach would be to approve the policy based solely on the underwriter's experience, without verifying compliance with the underwriting manual. This is ethically and regulatorily flawed because it bypasses established risk management protocols and potentially exposes the insurer to unmanaged risks. It also undermines the purpose of the underwriting manual, which is to provide a consistent and compliant framework for decision-making. Another incorrect approach would be to approve the policy and then flag it for a post-issuance review without immediate verification. This is problematic as it prioritizes speed over accuracy and compliance, potentially leading to the issuance of non-compliant or inadequately priced policies. Regulatory bodies expect proactive adherence to guidelines, not reactive correction after a policy has been bound. A third incorrect approach would be to reject the policy outright without a detailed review or attempting to understand the nuances of the risk. While caution is important, an underwriter's role is also to find ways to underwrite acceptable risks within guidelines. An outright rejection without proper investigation might indicate a lack of operational expertise in identifying potential solutions or a failure to engage in necessary dialogue to clarify information, which can also be detrimental to business relationships and market presence. The professional decision-making process for similar situations should involve a systematic approach. First, understand the request and the context. Second, consult relevant internal guidelines, underwriting manual and external regulations. Third, gather and verify all necessary information. Fourth, assess the risk and determine appropriate terms and pricing. Fifth, document the decision and the rationale. And finally, if there are ambiguities or deviations, engage in communication with the broker or agent to clarify or seek further information before making a final decision. Escalation to a senior underwriter or underwriter manager should occur when the situation falls outside the underwriter's authority or expertise, or when significant deviations from guidelines are contemplated. Question 15. To address the challenge of underwriting a significant commercial real estate property with a recently completed Phase I environmental site assessment (ESSA) that identified several recognized environmental conditions (REC), which approach best ensures compliance with commercial underwriting management principles and regulatory expectations for risk assessment. Option A. Accept the property owner's assurances that the identified RECs are historical and have been addressed, and proceed with underwriting to meet the transaction deadline. Option B. Request a detailed breakdown of the Phase I ESA's scope of work and thoroughly review the identified RECs, considering the need for a Phase II ESA or other specialized investigations to fully understand potential environmental liabilities before binding coverage. Option C. Underwrite the property with a higher premium to compensate for the potential but unquantified environmental risks identified in the Phase I ESA. Option D. Proceed with underwriting based on the Phase I ESA report, assuming the identified RECs are minor and do not pose a significant risk to the property's insurability, and focus on the overall financial strength of the borrower. The correct answer is D. Proceed with underwriting based on the Phase I ESA report, assuming the identified RECs are minor and do not pose a significant risk to the property's insurability, and focus on the overall financial strength of the borrower. Explanation. This scenario presents a professional challenge because the underwriter must balance the need to secure a profitable deal with the imperative to adhere to regulatory requirements and ethical underwriting principles. The pressure to close a significant commercial real estate transaction can lead to overlooking critical risk factors or misinterpreting underwriting guidelines, potentially exposing the insurer to undue financial loss and violating regulatory mandates. Careful judgment is required to ensure that all due diligence is performed thoroughly and that the underwriting decision is based on sound risk assessment, not solely on deal volume or perceived urgency. The correct approach involves a meticulous review of the environmental reports, specifically focusing on the scope of the Phase I ESA and any identified recognized environmental conditions (REC). The underwriter must then assess the potential impact of these RECs on the property's value and insurability, and if necessary, recommend a Phase II ESA or other appropriate remediation measures before binding coverage. This aligns with the regulatory framework for commercial underwriting, which mandates prudent risk management and a thorough understanding of the risks being insured. Ethically, it upholds the principle of acting with due care and diligence, ensuring that the insurer is not exposed to undisclosed or unmanaged environmental liabilities. An incorrect approach would be to proceed with underwriting without a thorough understanding of the environmental report's findings, assuming the Phase I ESA is sufficient without scrutinizing its scope or identified RECs. This fails to meet the regulatory requirement for comprehensive risk assessment and could lead to the insurer assuming liability for pre-existing environmental contamination, a clear ethical failure in due diligence. Another incorrect approach would be to dismiss the identified RECs as minor without further investigation, potentially underestimating the environmental risk. This demonstrates a lack of professional skepticism and a failure to adhere to the principle of prudent underwriting, which requires a proactive approach to identifying and mitigating all material risks. Finally, an approach that prioritizes closing the deal over conducting adequate environmental due diligence, perhaps by accepting the property owner's assurances without independent verification, represents a significant ethical lapse and a violation of regulatory expectations for sound underwriting practices. Professionals should employ a decision-making framework that prioritizes risk identification and mitigation. This involves understanding the specific regulatory requirements applicable to the transaction, thoroughly reviewing all submitted documentation, and exercising professional judgment to assess potential risks. When faced with uncertainty or potential red flags, such as those presented by environmental reports, the framework dictates seeking clarification, requesting additional information, or recommending further investigation, rather than making assumptions or prioritizing deal closure over risk management. Question 16. Analysis of the operational strategies for loan monitoring and servicing in a commercial lending portfolio, which approach best aligns with the regulatory framework governing borrower rights and fair treatment within the Associate in Commercial Underwriting Management (OM) exams jurisdiction. Option A. Utilizing automated collection notices that are sent immediately upon the first missed payment, without prior personalized communication or assessment of the borrower's circumstances, to ensure swift recovery of funds. Option B. Outsourcing all borrower communication and dispute resolution to a third-party vendor with minimal oversight, prioritizing cost reduction over the quality and regulatory compliance of borrower interactions. Option C. Implementing a tiered system for borrower inquiries, where only those exceeding a certain threshold of delinquency receive prompt attention to optimize servicing resources. Option D. Establishing a robust system for timely and accurate processing of payments, diligent management of escrow accounts, and proactive, transparent communication with borrowers regarding their loan status and any potential issues, while strictly adhering to all disclosure and notification requirements. The correct answer is C. Implementing a tiered system for borrower inquiries, where only those exceeding a certain threshold of delinquency receive prompt attention to optimize servicing resources. Explanation. This scenario presents a professional challenge because it requires an underwriter to balance the lender's need for efficient loan servicing with the regulatory imperative to protect borrowers' rights and ensure fair treatment. The core of the challenge lies in interpreting and applying the specific regulations governing loan monitoring and servicing within the Associate in Commercial Underwriting Management (OM) exams jurisdiction, which is assumed to be U.S. federal regulations for this context. Careful judgment is required to avoid practices that could be construed as predatory or non-compliant, even if they appear to streamline operations. The correct approach involves a proactive and transparent system for loan monitoring and servicing that prioritizes borrower communication and adherence to all disclosure requirements. This approach is right because it directly aligns with the principles of fair lending and consumer protection embedded in U.S. federal regulations. Specifically, it ensures that loan servicing activities, such as payment processing, escrow management, and handling of delinquencies, are conducted in a manner that is both accurate and compliant with laws like the Real Estate Settlement Procedures Act (RESPA) and the Truth in Lending Act (TILA). By maintaining clear communication channels and adhering to established procedures for addressing borrower issues, the lender upholds its legal and ethical obligations, minimizing the risk of regulatory action and reputational damage. An incorrect approach that focuses solely on minimizing servicing costs by delaying responses to borrower inquiries, or by implementing automated systems without adequate human oversight, fails to meet regulatory standards. Such an approach risks violating RESPA requirements for timely acknowledgement of borrower inquiries and proper handling of escrow accounts. Another incorrect approach that involves aggressive collection tactics without proper notification or adherence to the Fair Debt Collection Practices Act (FDCPA) would be a significant ethical and legal failure, potentially leading to severe penalties. Furthermore, an approach that neglects to provide clear and accurate loan statements, thereby hindering a borrower's ability to understand their obligations, would contravene TILA disclosure requirements. The professional decision-making process for similar situations should involve a thorough understanding of all applicable federal and state lending regulations. Underwriters must prioritize compliance and borrower protection, even when faced with pressures to reduce operational costs. This requires a systematic review of servicing policies and procedures to ensure they are not only efficient, but also legally sound and ethically responsible. When in doubt, seeking clarification from legal counsel or compliance officers is a critical step in ensuring adherence to regulatory frameworks and maintaining professional integrity. Question 17. The investigation demonstrates that a commercial entity seeking insurance coverage has presented financial statements that appear strong on the surface, with consistent revenue growth and healthy profit margins. However, a deeper review of the footnotes reveals significant reliance on accounting estimates for revenue recognition and the valuation of intangible assets, with recent changes in methodology that are not fully explained. Which approach best addresses the potential impact of these accounting choices on the underwriting decision? Option A. Accept the financial statements at face value, assuming the reported figures accurately reflect the company's performance and risk profile, as they have been audited. Option B. Request a revised financial statement that uses more conservative accounting methods, as this will provide a clearer picture of the company's true financial position. Option C. Focus solely on the company's historical loss experience and market comparables, as these are the most direct indicators of future claims. Option D. Conduct a detailed review of the accounting policies disclosed in the footnotes, paying close attention to areas involving significant estimates and any recent changes in methodology, to understand their potential impact on reported financial health and risk. Correct answer is A. Accept the financial statements at face value, assuming the reported figures accurately reflect the company's performance and risk profile, as they have been audited. Explanation. This scenario is professionally challenging because it requires the underwriter to move beyond a superficial review of financial statements and delve into the underlying accounting policies. The impact of accounting choices on reported financial performance can significantly alter the perceived risk profile of a commercial entity. A robust risk assessment necessitates understanding how these choices might obscure or inflate profitability, cash flow, or asset values, thereby affecting the underwriting decision regarding policy terms, pricing, and even the decision to offer coverage at all. The underwriter must exercise professional skepticism and judgment to identify potential red flags that could indicate aggressive accounting practices or a deliberate attempt to mislead. The correct approach involves scrutinizing the footnotes to the financial statements for disclosures related to significant accounting policies, particularly those involving estimates and judgments. This includes examining revenue recognition methods, inventory valuation techniques, depreciation policies, and the accounting for intangible assets. By understanding these choices, the underwriter can assess their potential impact on the company's financial health and its ability to meet its obligations. For example, a change in revenue recognition from a point in time to a percentage of completion method, if not adequately justified and disclosed, could artificially boost reported revenue in the short term, masking underlying operational issues. Regulatory frameworks, such as those governing financial reporting and disclosure, e.g., GAAP or IFRS, depending on the jurisdiction specified for the OM exam, mandate transparency in these areas. Ethical considerations also demand that underwriters act with due diligence and integrity, ensuring that their decisions are based on a comprehensive and accurate understanding of the risk, rather than on potentially misleading financial presentations. An incorrect approach would be to solely rely on headline financial ratios without investigating the accounting policies that underpin them. For instance, accepting a high gross profit margin without understanding the inventory valuation method, e.g., FIFO vs. LIFO or weighted average, could lead to an underestimation of risk if the chosen method inflates reported profits during periods of rising costs. This fails to meet the due diligence expected of a professional underwriter and could violate regulatory requirements for a thorough risk assessment. Another incorrect approach is to overlook changes in accounting policies from one reporting period to the next. Such changes, if not accompanied by clear explanations and a demonstration of their benefit or necessity, can be a signal of an attempt to manipulate financial results. Ignoring these changes would be a failure to identify potential risks and could lead to adverse selection, where the insurer takes on risks that are significantly more hazardous than anticipated. A professional decision-making process for similar situations should involve a systematic review of financial statements, starting with the primary statements and then moving to the accompanying notes. A critical step is to identify areas where management has significant discretion in accounting estimates and judgments. This requires an understanding of common accounting policies and their potential implications. When unusual or aggressive accounting choices are identified, the underwriter should seek further clarification from the applicant, potentially requesting supporting documentation or explanations. If concerns persist, the underwriter may need to adjust their risk assessment, pricing, or even decline coverage, always documenting the rationale for their decision. This process aligns with the principles of sound risk management and adherence to regulatory and ethical standards. Question 18. During the evaluation of a new commercial insurance policy for a software development company, the underwriter encounters a contract with a client that includes a significant upfront payment for a multi-year software development project. The contract specifies that the payment is non-refundable and due upon signing, but the software development work will be delivered incrementally over the next 3 years. The client has also signed a separate, but related, service agreement that allows them to defer the commencement of the actual development work for 6 months after the initial payment, with no penalty. The underwriter needs to determine the appropriate timing for revenue recognition for the insurance policy covering this project. Which of the following approaches best reflects the principles of revenue recognition in this scenario? Option A. Recognize the full insurance premium revenue upfront upon signing of the contract, as the payment is non-refundable and received. Option B. Recognize the insurance premium revenue based on the client's ability to defer the commencement of development, as this indicates uncertainty. Option C. Recognize the insurance premium revenue over the term of the software development project, aligning with the delivery of services. Option D. Recognize the insurance premium revenue over the period the insurance policy is in effect, regardless of the client's ability to defer the commencement of development. The correct answer is A. Recognize the full insurance premium revenue upfront upon signing of the contract, as the payment is non-refundable and received. Explanation. This scenario is professionally challenging because it requires the underwriter to distinguish between a genuine business transaction and a potential arrangement designed to artificially inflate revenue figures, which could mislead stakeholders and violate accounting principles. The underwriter must exercise due diligence and apply professional skepticism to ensure that revenue is recognized only when earned and realized, in accordance with applicable accounting standards. The correct approach involves scrutinizing the substance of the transaction over its legal form. Revenue should only be recognized when the entity has transferred control of goods or services to the customer, in an amount that reflects the consideration the entity expects to be entitled to in exchange for those goods or services. This aligns with the core principles of revenue recognition, which emphasize that revenue should be recognized when performance obligations are satisfied. In this case, the underwriter must assess whether the customer has truly received the benefit of the services and whether the payment is unconditional. An incorrect approach would be to simply accept the stated revenue amount based on the invoice or contract without further investigation. This fails to acknowledge the potential for side agreements or conditions that may prevent the revenue from being considered earned. Another incorrect approach would be to recognize revenue based on the signing of the contract alone, irrespective of whether the service has been delivered or control has been transferred. This violates the principle that revenue recognition is tied to the satisfaction of performance obligations. Finally, recognizing revenue based on the expectation of future payment, without a clear indication that the payment is unconditional and collectible, is also an improper approach. Professionals should adopt a systematic approach to revenue recognition by understanding the underlying business purpose of transactions, identifying all contractual terms and conditions, assessing the transfer of control, and ensuring that all criteria for revenue recognition are met before booking the revenue. This involves critical thinking, professional skepticism, and a thorough understanding of the relevant accounting framework. Question 19. Quality control measures reveal that a long-standing commercial client has submitted an insurance renewal application for a significant property. The client has provided their own valuation of the property, which appears to be considerably higher than recent comparable sales data suggests. The underwriter, who has a good personal relationship with the client, is under pressure to process the renewal quickly to maintain client satisfaction. What is the most appropriate course of action for the underwriter? Option A. Conduct an independent, professional appraisal of the property to determine its fair market value, regardless of the client's provided figure or the pressure for a quick renewal. Option B. Inform the client that their valuation seems high and suggest they obtain a second opinion from another appraiser, but proceed with the renewal based on the client's figure if they insist. Option C. Accept the client's provided valuation, assuming they have a vested interest in accurately valuing their asset, and proceed with the renewal to maintain the relationship. Option D. Apply a standard industry multiplier to the client's provided valuation to account for potential market fluctuations, thereby expediting the process. The correct answer is A. Conduct an independent, professional appraisal of the property to determine its fair market value, regardless of the client's provided figure or the pressure for a quick renewal. Explanation. This scenario presents a professional challenge because it pits the underwriter's duty to accurately assess risk and value assets against potential pressure to accommodate a long-standing client relationship. The underwriter must navigate the ethical imperative of objective valuation with the business reality of client retention. The core tension lies in ensuring that the valuation reflects the true economic reality of the asset, rather than being influenced by personal relationships or the desire for expediency. The correct approach involves a rigorous and objective valuation of the commercial property, adhering strictly to established industry standards and the insurer's internal guidelines for asset appraisal. This means utilizing qualified, independent appraisers and ensuring that all valuation methodologies are sound, well-documented, and defensible. The regulatory framework for commercial underwriting, particularly as it pertains to asset valuation, mandates transparency, accuracy, and a fiduciary duty to the insurer to underwrite risks appropriately. This approach upholds these principles by prioritizing factual data and professional judgment over subjective influences. An incorrect approach would be to accept the client's provided valuation without independent verification. This fails to meet the underwriter's responsibility to conduct due diligence and accurately assess the risk associated with the insured asset. Ethically, it compromises the underwriter's objectivity and could lead to mispricing the insurance policy, potentially exposing the insurer to financial loss. It also violates the principle of fair dealing with all clients, as it suggests preferential treatment based on relationship rather than objective risk assessment. Another incorrect approach would be to apply a rule of thumb or a simplified valuation method that is not supported by market data or professional appraisal standards. While this might seem efficient, it lacks the necessary rigor and can lead to significant inaccuracies in asset valuation. This approach disregards the regulatory expectation for thoroughness and can result in an underestimation or overestimation of the asset's value, both of which are detrimental to sound underwriting and risk management. A third incorrect approach would be to delay the valuation process or to overlook discrepancies in the provided documentation in an attempt to avoid confronting the client. This procrastination, driven by a desire to maintain client harmony, ultimately undermines the underwriting process. It creates a false sense of security and can lead to the acceptance of a policy based on an inaccurate understanding of the underlying asset's value, which is a direct contravention of professional and regulatory obligations. A professional decision-making process for similar situations should involve a clear understanding of the underwriter's responsibilities, including the obligation to perform independent and objective asset valuations. When faced with potential conflicts or pressures, the underwriter should consult internal guidelines, seek advice from senior colleagues or legal counsel if necessary, and always prioritize adherence to regulatory requirements and ethical principles. The focus should remain on the integrity of the underwriting process and the accurate assessment of risk, ensuring that business relationships do not compromise professional judgment. Question 20. The assessment process reveals a pattern of unusually low claims frequency for a specific segment of commercial policies, coupled with a slight increase in the number of policy cancellations shortly after inception, and some inconsistencies in the reported financial data of applicants. Which of the following approaches best addresses the potential for fraud in this scenario? Option A. Focus on improving the efficiency of the claims processing department to handle the existing volume, as the low claims frequency suggests no immediate fraud concerns. Option B. Increase underwriting scrutiny on all new applications within that segment, focusing on verifying financial data and investigating the reasons for early cancellations, while leveraging data analytics to identify any unusual claim reporting patterns. Option C. Assume the low claims frequency indicates effective risk management by policyholders, and proceed with standard underwriting procedures, only investigating claims that exceed a predefined threshold. Option D. Reevaluate the historical loss ratios for that segment to confirm if the current low claims frequency is within acceptable historical deviations, and adjust pricing accordingly. The correct answer is B. Increase underwriting scrutiny on all new applications within that segment, focusing on verifying financial data and investigating the reasons for early cancellations, while leveraging data analytics to identify any unusual claim reporting patterns. Explanation. The assessment process reveals a potential for fraud within a commercial underwriting portfolio. This scenario is professionally challenging because it requires underwriters to balance the need for efficient risk assessment with the imperative to detect and prevent fraudulent activities, which can have significant financial and reputational consequences for the insurer. Careful judgment is required to distinguish between genuine underwriting risks and deliberate misrepresentations. The correct approach involves a multifaceted strategy that combines data analytics, behavioral red flags, and a robust internal control framework. This approach is right because it aligns with the principles of sound underwriting and regulatory expectations for fraud prevention. Specifically, regulatory frameworks for commercial insurance underwriting, such as those overseen by bodies like the NAIC in the U.S., assuming U.S. jurisdiction for this exam, emphasize the insurer's responsibility to implement measures to detect and prevent fraud. This includes utilizing technology to identify suspicious patterns, training staff to recognize indicators of fraud, and establishing clear procedures for reporting and investigating potential fraudulent claims or applications. Ethical considerations also mandate that insurers act with integrity and protect their policyholders and stakeholders from the financial drain of fraud. An incorrect approach that relies solely on historical loss ratios without considering emerging fraud trends is professionally unacceptable. This fails to proactively address new or evolving fraud schemes and may lead to underestimation of fraud risk, potentially resulting in inadequate pricing and reserves. It also neglects the regulatory expectation to adapt fraud detection methods to current threats. Another incorrect approach that involves ignoring minor discrepancies in application data, assuming they are unintentional errors, is also professionally flawed. While some discrepancies may be minor, a pattern of such discrepancies, or even a single significant one, could be an indicator of deliberate misrepresentation. A failure to investigate these could violate the duty of due diligence and potentially lead to underwriting policies based on false information, which is a regulatory concern and an ethical lapse. A further incorrect approach that prioritizes speed of underwriting over thoroughness by skipping verification steps for certain applicant information is professionally unsound. This creates vulnerabilities that fraudsters can exploit. Regulatory bodies expect insurers to maintain reasonable standards of care in underwriting, and this approach undermines that expectation, potentially exposing the insurer to significant losses and reputational damage. The professional decision-making process for similar situations should involve a systematic evaluation of all available information, including application data, third-party verification, and industry fraud intelligence. Underwriters should be trained to identify common fraud indicators and empowered to escalate suspicious cases for further investigation. A commitment to continuous improvement in fraud detection techniques, informed by data analytics and regulatory guidance, is crucial for maintaining the integrity of the underwriting process.